Hello there, welcome to The Open here on BNN Bloomberg. Let's get to the stories we're bringing you from our newsroom. Multiple reports suggest Ottawa and Alberta have agreed to the broad terms of a deal to support a new oil pipeline to Canada's west coast. The reports say provincial and federal leaders are set to announce special exemptions and political support on Thursday. The BC Premier, David Eby, has been opposing the plan. He told reporters yesterday that he spoke with the Prime Minister, Mr. Carney, who told him the details had not been finalised. Canadian convenience store giant Alimentation Couche-Tard posted mixed results in its latest quarter. Profit beat expectations, while revenue was slightly below estimates. Sales were driven by same-store merchandise revenue growth across all regions in Canada, US, and Europe. The owner of Circle K says the results were also boosted by acquisitions, but fuel prices were lower and wholesale fuel revenue fell. Shares in coal soaring in the pre-market. The U.S. discount retailer boosted its full-year outlook for a second straight quarter. Comparable sales fell in the latest 3 months, but by less than analysts had feared. On Monday, Kohl's named the interim chief Michael Bender as its permanent CEO. And U.S. futures, you can see, pointing downwards right now after a strong rally yesterday. Of course, we are nearing December, which tends to be a great month for the markets. Let's have a look at the TSX, and it was boosted yesterday in part by a huge rally in Celestica amid optimism over tech stocks in general. Let's have a look at oil. Oil under pressure on reports that Ukraine may be amenable to accepting at least some of that latest peace deal proposed by the United States to end the war with Russia. Let's have a look at gold, and gold holding its own today, not far short of $4,200. Canadian dollar, pretty flat today, still stuck below 71 cents US. And finally, Bitcoin. Bitcoin has come under severe pressure in recent months. We saw a slight rally in the crypto sector yesterday, but fresh pressure today. It looks like U.S. stocks will slip at the open today. Yesterday, though, they jumped despite last week's fears of an AI bubble. Our guest says that skepticism is lingering, but data suggests we'll continue to see durable expansion supported by fundamentals. We're joined by Philip Peterson, Chief Investment Strategist at IG Wealth Management. Philip, great to see you. And when we talk about durable expansion, are we talking in particular tech spending?
It's part tech spending, but there's a lot into it. So thank you, Andy, for having me on. We've just released our 2026 outlook, and we've identified 4 pillars that we believe are going to stand up the economy and support growth into next year. And these are monetary stimulus, fiscal stimulus, the AI spending, and then the wealth effect. So it's not just AI. There's everything around it. And we saw that with the third quarter results that most sectors participated. There was only one sector that was down year over year on earnings, and that was the energy sector. Every other sector presented very, very strong earnings growth and surprised to the upside. So this is a good lead-in into next year.
And you're not concerned that eventually the financing will start to dry up for AI until people see sustainable profits from all this investment?
Well, the financing might dry up, and that is something that you're seeing pop up in the news more and more as these large companies now are having to turn to the credit markets to finance some of these AI initiatives. Mm-hmm. But right now, we're still seeing that real money flow through. And so while future investment might start to slow down, we've got a solid core going into next year that we think is going to be very, very supportive. Now, it could be more of a 2027 story where we start to see things turn a little softer on AI, because there the proof will need to start having to be realized in terms of the investments and then the returns on these investments. But for now, we remain optimistic that the 1 to 1.5% of AI spending going into the global economy as a percentage of U.S. GDP is still going to be fairly solid.
And we hear a lot about this wealth effect, whereby households, especially in the United States, when they own stocks, they see the value of their holdings go up and they're inclined to spend. I guess that cuts both ways. If the market did take a big downturn, it would tend to cut into confidence.
It does, but interestingly, the research shows that as a dollar of financial wealth is realized by households in the United States, about 15 to 25 cents of that, or 15 to 25%, is spent. Now, when we see the markets down, it doesn't mean you have an equal decline. Now, I guess it remains to be seen if we were to see a meaningful decline over the near term, what that would do to consumption. But in the meantime, we've had 3 very, very strong years of growth for investors. Think of even your average balanced fund that has delivered double-digit returns over the last 3 years on an annualized basis. This is being realized and being spent by consumers, not only in the United States, but we think in Canada and other areas around the world. And
you note, I think you touched on this, that governments are in stimulus mode, even if the interest rate cuts are coming to an end. Both in Canada and the States, they're talking about big spending or tax cuts.
Exactly. Remember, OB3, or the One Big Beautiful Bill, a lot of those tax cuts come into place at the beginning of 2026, and that is going to be quite stimulative. We think you're going to have a massive extension of the tax cuts for corporations, but also households. If you look at households earning more than $217,000 a year, they're going to see an average tax cut of $12,000. I mean, that's quite meaningful. We do talk about the K-shaped economy, but it's the consumer that's the top end of that K that is most important to the economy and to stock markets.
So what kind of stocks do you think will do well next year, Philip? Is it possible to generalize?
Well, we think we look geographically first. And so when we look at that, we are equal weight in the United States. So we still have a positive outlook for U.S. equities in 2026. But we see an extension of the outperformers that we've enjoyed in 2025 continuing on in 2026. So this is the Canadian equity market, the TSX. We think international stocks will continue to perform quite well and outperform U.S. stocks. Additionally, emerging market stocks we think are continued or poised to continue to outperform. So we're overweight Canada, international, emerging markets relative to the United States, but we're overweight equity over fixed income heading into the new year.
Right. Sorry, what was that last thing about fixed income bonds?
Right. So we're underweight fixed income relative to the equity markets. We just believe that fixed income is still attractive, but the returns that you're going to see are about 3-4% for a broad-based fixed income portfolio. And we believe the equity markets can do better. Now, as we look through to the real downside risks of the market, and that's the risk of recession, that tends to lead to deep bear markets. We don't see a significant risk of recession into 2026. And so therefore, we have a much higher probability of continued positive returns for the equity markets that should be multiples of what we can get out of fixed income. That's why we're overweight equity, underweight fixed in our portfolios.
And is one reason to be cautious about fixed income the risk of inflation, or is inflation pretty well under control now?
We believe inflation's under control. So when we model it out over the course of the next 6 to 9 months, both in the United States and Canada, we see inflation settling into its targeted range. So in Canada, that's 2% plus or minus 1. We might see inflation a little bit higher in the next couple of months. That's more math related than real price impact related. And then it's going to ease back down closer to 2% by the middle of 2026. In the United States, here too, we have inflation targeted around 2.5%. So a little bit higher than the Fed's 2% target, but still in line with the historical norm. So inflation is no longer a problem for the central banks. We think that the focus is going to shift more towards economic support, and that's where we see 4 cuts by the Fed next year, only 1 by Canada.
Oh, that's interesting. Yeah, well, of course, Canada is well ahead in that cutting cycle. Thank you very much, Philip. Really appreciate it. Philip
Great pleasure.
Peterson,
Thank you.
Chief Investment Strategist at IG Wealth Management. Up next, U.S. retail spending rose in the latest month, but at a slower pace, indicating that consumers may be hitting pause. We'll be right back. U.S. retail sales were up again in September, but at a slower pace. That's after several months of strong growth. Let's get more from Alex Gracino, Global Chief Economist at Manulife Wealth and Asset Management. Thanks very much indeed for joining us. I suppose we should start off with the caveat that this data is kind of stale and distorted because of the government shutdown.
It is. Generally speaking, when we look at the data right now, we lump it into three general categories. The first is the data's fine, but it's old, so it tells us what we needed to know about a month ago now. The second is data that will be distorted, either because they just didn't collect it or because it will have been affected by the government shutdown. And the third is getting back to normal, and we're certainly not there yet. We figure that happens sometime early in 2026.
Any patterns jumping out for you, though?
In the retail sales data, outside of generalized softness, which was undercut even more by strong gas station sales, which is usually driven by prices, to me, the important thing is you look at the end of Q3, which is softer. So you're going to see a lot of the nowcasting for GDP get revised down a bit, so slightly less upbeat than the 4% you've been seeing. And it also creates a bit of a softer handoff into the fourth quarter, which is starting to look a little bit softer than people might have expected even a couple of days ago.
Is retail sales data important to the Fed?
I think it is critically important because when you look at the trade-off between inflation and labor, part of what labor becomes is a general proxy for growth. And in the United States, the consumer really is the straw that stirs the drink. So you want that to stay healthy going through to the rest of the year. So at the margin, this will have reinforced the Doves case for the December 10th meeting.
And why would there be pressure on retail sales in the United States? I know the labor market has shown some signs of softness, but economic growth hasn't tanked.
It hasn't at all. So far, we think that the retail sales will actually, or general consumption will actually be fine over the next little while, but the generalized uncertainty from the shutdown will have affected the data for the next few months generally. And that is one of the things that we think could weigh. Also, you're looking at the lagged effects of tariffs perhaps starting to kick in a little bit. Again, we're not overly concerned about the U.S. economy at this stage, but we do think those things will weigh a little bit at the margin.
What consumer confidence obviously doesn't always reflect what's happening in the economy. Are Americans pessimistic right now?
So I think it's one of those climbing the walls of worry type things where if you look at consumer sentiment, it is at extremely low levels. And then when you look at what people actually do, i.e. voting with their wallets, they're still going out and spending. And I think that speaks to the resilience of the U.S. consumer generally. I think you discount the U.S. consumer at your own risk. I think it takes a real shift or a real shake in confidence for the consumer to actually stop spending. And it's beyond surveys.
And what about this much ballyhooed K-shaped recovery? Do you buy into the thesis that we often hear that lower income groups are faring much worse or significantly worse?
I do. I think there's considerable evidence of that case. The reality is at this stage that the top end of the K is driving the economy. So when you look at the overall data, it's a little bit of a head in the oven, foot in the freezer type of situation where there's a large group of people who are actually doing just fine and spending more. And then there is a separate group that is increasingly uncomfortable with where things are.
So does that matter in the sense that they have less money to, of course it matters for them personally, and it's a question of income inequality and justice, but is that important for the economy that the lower income group are not doing well?
I would say ultimately it does, because if that tilts in or starts creeping up towards the middle of that K, so I guess that gap, what effectively happens is you will start to see a meaningful impact on overall economic growth. And I think what it will take is really for people to get increasingly more nervous about job prospects. I think if you're comfortable with your job, but you don't think you can get another one, you keep spending. If you start to worry about keeping your job, then maybe you start to tighten your belt a little bit. We're not quite there yet, but we do see the labor market looking tired at this stage.
And can you comment on tariffs? We keep hearing that despite all the fears in April that tariffs would be extremely disruptive, you remember the stock market slid. Is it fair to say that tariffs have not been that disruptive to the economy yet?
So I think this is an excellent point in distinguishing market pricing from macro lags. People look at tariffs and they assume they happen immediately, and you will see the effect in the next 2 to 3 months of data. I think what, in fact, you do see is a slow seeping into the broader data, and we're probably getting closer to that point now.
Right.
So it's sort of like you're in that gap at this stage.
Right. So the tariffs will have an effect, but there's still the lag.
Yes. I don't think it's going to be as extreme as people were worried about by any stretch, but I think you do get that sort of feeling of being underwhelmed at some point as you look at some of the data that comes through.
Could you just put it in perspective for us? Under the previous administration of Joe Biden, the government went ahead with massive support for industrial expansion in the United States. Mr. Trump, of course, has reversed some of Joe Biden's policies, especially in the area of renewable energy, for example. But do we have big industrial investment going on in the United States right now?
Oh, I think there's no question. If you look at areas like AI and you see new deals being printed almost daily, there is a lot to be excited about. The way we look at 2026 is we get through a 4 to 6 months where we're a little bit leery, not outright concerned, but it's sort of proceed with caution. And then as you get farther into the year, things like fiscal stimulus start to kick in, lower monetary policy starts to kick in. And frankly, just time, being used to the current operating environment will help people make decisions over the course of the year. And AI is certainly a massive contributor to that at this stage.
Will AI, go to 30,000 feet if you would, will AI be as big as the advent of the internet over the next decade or so?
Hold up. Over the next decade, there's certainly a lot of potential there. I don't think it's going to be a vertical or a diagonal line up and to the right, though. I think there will be twists and turns in the story, but right now we're certainly at a very exciting phase.
Thank you very much. I really appreciate it, Alex. Alex Gracino, a global chief economist.
My pleasure. Thanks for having me.
At Manulife Wealth and Asset Management. Up next, we're going to drill into those numbers from Alimentation Couche-Tard, the huge seller of cigarettes and gasoline. We'll be right back. Couche-Tard seems to be seeing signs of a bounce in profits. Just reported second quarter earnings. Let's get more from BNN Bloomberg's Lindsay Biscaya. Lindsay.
Yeah, so profit beat expectations, Andy. Revenue was slightly below estimates at $17.9 billion US. But many analysts say that this is the start, it looks like, of a slow recovery for the company. Of course, all last year, Couche-Tard was so focused on the acquisition of that Japanese company behind its rival 7-Eleven. And so now it looks as though the company is starting to kind of reshift its focus and be on a slightly upward trajectory. So when we're talking about these second quarter earnings, net earnings were at $740.6 million US. That's compared to $708 in the same quarter of last year. Total merchandise and service revenues was up 6.6% from a year earlier. The CEO says the company also reported same-store sales growth of more than 5% in Canada. When it comes to the US, for the first time in 7 quarters, Couche-Tard increased same-store sales growth in the US of 1.2%. So it doesn't sound like a lot when you hear 1.2%, but that's a tripling of growth.
I know it's a long drought, it sounds like.
Yeah, it's been a long drought. So starting to turn things around, starting to refocus. And this morning we spoke with Peter Hodson at I2I Capital Management, and he says this shows really what cost discipline can do for a company. Take a listen.
They did miss on the top line a little bit, but their earnings were better than expected, and they had about a 2% revenue growth, but their profits rose by 4.1%. So it's a very, very well-run company with, very high free cash flow. They've done great acquisitions. And it's a situation where it's like one of those sleeper stocks that's done so well over the past 20 years. And, maybe it's not that exciting this year. The stock's down. But there's other excitements going on, and people are like, oh, I don't need them right now. But their time will absolutely come when the market shifts a little bit.
So Hudson's saying he's hoping maybe in the future for some big acquisitions for the company. But at this point, they do still have a lot of goals in mind, right? The CEO was on a conference call this morning talking about they're well on their way of 500 new stores in 5 years. That's a goal of theirs, with 29 new stores open since May. So obviously a lot of different ways here trying to kind of turn things around for this company.
And the dividend is going up.
Yes, dividend has been raised 10%, so it's now about 1.2%. So still quite a small dividend, but raising it 10% really shows signs of how the company is potentially going to do. The company also bought back almost $900 million worth of stock so far this year. So again, it hasn't been making those acquisitions, those really large acquisitions that it's wanted to. But when we were speaking with Hudson earlier this morning, he was saying this shows that the company's kind of using that free cash flow to do other things as well as opening new distribution centers. That's something the company's really focusing on in the U.S. as well.
I was just in Ireland, and the stores are everywhere, Circle K stores.
So, yeah, the CEO did say that they're expanding everywhere. Of course, they are already across Europe, but Ireland is one of the places that their focus is in terms of expanding.
Yeah, I mean, corner stores and also highway stops. And I was in one that was beautiful. I think it was brand new, but lovely looking food, lovely modern layout. Maybe it was just brand new. And so
maybe that's the way they look when in Ireland.
Yeah. Well, I was pretty impressed. Thanks very much,
Thank
Lindsay.
you.
Lindsay Biscaya. We are going to check out the U.S. futures now because it looks like we could get a slightly soggy open for stocks today. Okay, you can see after a rally yesterday, the U.S. market drifting down in pre-market trading. No big deal. Let's have a look at gold and see how that's faring. And gold holding in now, up, as you can see, 1%. Remember, spot gold got to record highs last month of just under $4,400. And let's check out oil because not a great day for oil. The good news is that there may be an end to the fighting approaching in Ukraine, but critics of this proposed deal by the United States saying that it amounts to just handing Mr. Putin of Russia what he wants. But there are suggestions that Ukraine is amenable to at least parts of the proposal. And finally, let's have a look at Bitcoin. Bitcoin has been a miserable story for investors over the past couple of months, but there you have it. Crypto, the criminal's little helper, as I like to call it. You can see Bitcoin under pressure right now. We've got those opening bells up next. Opening bells at the NASDAQ. Ituran location and control are ringing the bell. At the NYSE, it's Aeromexico doing the honors. It's time for the first 15. Let's check in on the markets. We did get softness in futures south of the border before the open. You can see that is playing through here. The TSX, though, holding its own north of 30,660. Let me just check what the record high was for the TSX. Our market, of course, boosted this year in a big way by gold. Uranium has also been a hot commodity. So we're still down from the record high, November 12th, to 30,827. Some stocks of interest here. Let's have a look at Alimentación. Lindsay Biscaya was telling us about the profit beat at that company, and those shares up 4% in early trading. Let's have a look at H&R REIT, the big property player. That stock holding its own. Now, it's interesting. The company has ended its strategic review without a sale, but they're also reporting property sales of $1.5 billion in Canada and the United States. So the market seems fairly happy with that. Let's have a look at Barrick because they have got a breakthrough in regaining control of their gigantic mine in Mali. Of course, they have to pay some money to the Mali government, Mali in West Africa, and accept a mining code that they had previously rejected. And you can see the stock pretty flat today. Royal Bank and TD getting downgrades to hold at Jefferies. Jefferies saying it's hard to find value at all in the Canadian banking sector after the big run-up in these stocks. And Royal Bank, of course, has been hitting records over the past few days. And Jefferies analyst John Aiken now has no buys among the Canadian banks. Okay, so there is your look at stocks on the move in Canada and stocks of interest in early trading. Let's get some action south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Great to see you. Talk to us about the NVIDIA-Google rivalry escalating in the area of AI chips.
Escalating is right. So the information, which is a media source, reported that apparently Google is going to be, or is at least in talks to be, a supplier of AI chips to Meta,
wow.
the owner of Facebook. And this is sending the stock sharply higher. So Google is one of the top performing stocks in the S&P 500 this morning, getting a great big lift on that. And as you said, there is a rivalry here with NVIDIA, which is among the worst performing stocks in the S&P 500 so far this morning. But not only that, there's a few what we're calling kind of sympathy moves along with Google and with NVIDIA. So the suppliers to Google, which include Broadcom, that's the ticker AVGO, is also one of the top performing stocks this morning. And some of the suppliers to NVIDIA are also declining. So it's a really interesting dynamic that we see playing out here, where you now have these kind of two tech titans duking it out, battling it out for supremacy and for the supply of these chips. Google today is on pace potentially to hit $4 trillion in market capitalization. That's a number we're watching for in the course of the session.
That's amazing that Google themselves are a player in chips. You think that would be the last thing they'd be interested in getting into. Oracle, I mean, yeah, they're just everywhere, ubiquitous. Oracle getting a cut on debt concerns, Jeff.
Yeah, Oracle, this is an interesting one to watch. So our Oracle is down so far this morning. They were cut to hold at CFRA Research. This is a Wall Street shop, which sees debt concerns. This Oracle now has $100 billion worth of debt.
Whoa.
As a result, CFRA does not see Oracle hitting free cash flow levels, positive free cash flow levels, through at least 2028, which is certainly a long time to wait for. The company also, the firm also flagged concentration risk. So a whole, I guess, too much in CFRA's view, too much of CFRA or Oracle's business is conducted with OpenAI, and they see some concentration risk there for the company. The price target was cut from $350 to $230, which is not a street low for Oracle, but it's pretty close. So one to watch today as well.
And finally, Keysight. Remind us what they do and tell us why AI is boosting the results.
Yeah, Keysight, this is, we've kind of saved the best for last. This is the top performing stock in the S&P 500 this morning. What they do, they make a whole bunch of equipment. I'm going to mispronounce some of the names of these pieces of equipment. Oscillators, spectrum analyzers. If you go on their website and you have a look at some of these machines that they produce, they look like something out of a control room in maybe a James Bond movie. But they're getting a big lift this morning. So they beat quarterly results. They beat on earnings per share. They beat on revenue. And much of Wall Street really likes the outlook for this company. JP Morgan analysts were out this morning saying that they're a key trade or they will be a beneficiary of this AI technological build-out because of all of those aforementioned oscillators and spectrum analyzers and a whole bunch of other machines that they look fancy. I'm not sure exactly what they do.
Oscillators. You know, in the latest Bond, I was kind of broken-hearted that Blofeld died. Ernst Blofeld, A World Without Him, I'm just not interested. You know what? The Bond movie was so long that I stopped watching. It overstayed its welcome, much as I love Daniel Craig. Anyway, We better jump. Thanks very much.
Sounds good. Thanks, Andy.
Thank you.
Thank you.
Can we just, control room, can we have a quick look at Well Health here? I forgot to mention it earlier. The Globe has a story. There we are, down 5%. One of the biggest droppers in Toronto. The Globe says the Competition Bureau is going after the company over alleged lack of competition. Its big acquisitions this year are lessening competition for AI transcription and medical record software. And so according to the Globe, the Bureau filed an application in federal court trying to get information from Well Health. Interesting, they had to go to court to squeeze information out of them. Coming up after the break, we're going to get the latest on the market from Sadiq Adashia of BMO Asset Management. TSX soundly beating the S&P 500 this year. Is that likely to continue? We are joined by Sadiq Adashia, Chief Investment Officer at BMO Asset Management. Sadiq, thanks very much indeed. Really incredible, isn't it? Despite the big run for the US tech stocks, Toronto has held up so well.
Yeah, absolutely. And thanks for having me. Yeah, it's been an interesting year for sure. We've seen so much going on around the world, geopolitical risks, inflation concerns, changes on interest rates. But the truth is that we're still seeing a pretty healthy economy around the world. In Canada, international, emerging markets, all have played a little catch up to the United States. And so it's been a really well-diversified kind of rally across the world. And I think that's good for investors because it's not solely relied on the U.S., though I think the U.S. still remains a very strong economy and strong part of what you need to have in your portfolio. But it's good to see that we're seeing, a diversified mix of outperformers as well, too.
Are you concerned that cracks are emerging in the AI story? Maybe we can put up a 5-year chart for Oracle. It may be a special case, but there are concerns over a massive debt load of that company as it invests frantically in AI equipment.
Yeah, it's a great question. I mean, there's a lot of talk about it, whether there's an AI bubble going on. Have they spent way too much money and not getting enough payback? Our belief is that we're still in the early innings of AI still. And, what you're seeing coming out of China and other parts of the world are highlighting that this is going to be a big story, not just for 2025 or 2026, but for the next decade. And so, companies do need to spend to invest in that. You're seeing all the hyperscalers continue to do that. You just mentioned Oracle as one of the next hyperscalers in the space. And yes, you are seeing a bit of more use of debt versus actually cash to fund that, which is a little bit more concerning than previous. But I do think that as you look through, the strong players in this space are going to continue to dominate and continue to add good value through that AI spend. It's the other ones that are probably kind of just hovering around the edges that may not be able to get the bang for their buck. So to us, this is still an important theme that you want to continue to play out. Even saw the NVIDIA earnings to be exceptionally strong. So it just tells you still that the money's still being spent. There's still strong belief in what's going on. And we're still bullish on the theme.
You're still neutral on Canada, though. You're not tempted to overload or overweight this country in your portfolios?
Yeah, I mean, we obviously have a diversified portfolio, but where we think on the Canadian perspective is we're still seeing a kind of a weaker economy, employment not necessarily that strong, or GDP in that same level. We do still have some uncertainty on the tariff side, though there is some positivity that we might see the sectoral tariffs come down by about half. And we're heading into next year where we're going to have a rework of the USMCA deal. And though I think that should still be okay, it probably won't be the same terms that we're seeing so far this year. And so therefore, I do think we'll give up a little bit of that competitive advantage, not fully. And so I'd rather wait and see how things play out before we get overly optimistic about Canada. As you've seen over the last 6 months, the relationship in Canada and U.S. has gone back and forth numerous times. So I think I'd rather just wait out a little bit longer before we get overly optimistic about Canada turning the corner at some point next year.
Yeah, what would be your biggest concern about the Canadian economy?
Well, I think right now we're still struggling over a lot of debt. Though interest rates have come down, people have that big debt to deal with. The housing market hasn't really been exceptionally strong. And so consumer appetite is starting to wane, and that is an impact on, obviously, companies and GDP growth. So when we look through into next year, there isn't a catalyst right now that makes us believe that we're going to see consumers start spending excessively all of a sudden. Companies are still, holding back on, what they're going to spend on and look for growth on, because they're waiting for the clarity on the USMCA deal and on the tariff side. So that just holds back that growth ambition that you want to see companies have. And that probably puts a little bit of a cloud over the Canadian economy. And that keeps us, again, a bit more reserved on Canada than otherwise.
What about this? How are you playing Japan right now? Because there are fears, of course, that this notorious or famous carry trade, whereby people would borrow cheap in Japan and invest for higher returns elsewhere, that might be eroding as Japanese rates come up.
Yeah, that's an excellent point. Japan has had a good, a year. But as you have just mentioned, we are seeing some of the things change around, rates going up, inflation changing as well. So it's not the same Japan that you may have known over the last few years. On the positive side, there are things that are getting better within the corporation side. You're seeing more policies that are tied to investor-friendly investing, and that is good because that means it's tied to shareholder value. And that is a positive sign, from a longer-term perspective. But I think in the short term, when you look at Japan, I think it's a bit overvalued at the moment. However, relative to maybe other European countries and broader international markets, I do think it's still, a relevant story to have. But again, I wouldn't be as overly excessive about it, given the run-up we've seen so far.
And just finally, bonds. Maybe we could put up the Canadian 10-year bond yield. Are you attracted by it, Sadiq, these days?
So we are neutral on Canadian bonds and U.S. bonds. I think when we're looking at things, I think we'll be more optimistic about U.S. bonds versus Canada, just because I think there's probably more room for the U.S. to cut rates than Canada at this stage. However, we still think we prefer, if we're going to take on any risk in the markets, we prefer equities over bonds. So again, if we're going to have bonds, we're going to have it more as a protection, which means more of a conservative nature versus credit, high yield, or emerging market debt. I think if we want to take on that credit risk, we'd rather take it in the equity market. So overall, we're kind of neutral on the bond market. Probably get a 5-6% return next year, but I wouldn't look for anything excessive past that unless we have a really strong, rate cutting cycle.
Sadiq, thank you very much indeed. Sadiq Adasha,
thanks for having me.
Chief Investment Officer at BMO Asset Management. Okay, so on Friday on Market Call, we were joined by Paul Harris, partner and portfolio manager at Harris Douglas Asset Management. His focus, North American and global stocks, and his top picks were First Service, Zoetis, Adobe. And today on the show, we have Andrew Moff, Senior VP and Portfolio Manager at Vision Capital. His focus, real estate stocks. Let me correct myself there. Paul Harris was on yesterday, not on a Friday. Sorry about that. Okay, but Andrew Moff's always intriguing, and he always drills into real estate for us. Up next, we're hearing that Alberta and Ottawa have agreed to broad terms on a deal to support a new oil pipeline to Canada's west coast. We're hearing that Ottawa and Alberta are nearing an outline deal anyway on building a new pipeline through BC. Let's get more from our CTV News colleague, Colton Prail. Colton, thanks very much for giving us the time. What's the latest, please?
Yeah, the latest is that sources are telling us Carney and Smith are expected to sign an MOU or announce the signing of an MOU in Calgary on Thursday. Carney expected to be at the Calgary Chamber of Commerce presenting that day. Now, it's important to note that the sources do say that timing is not finalized yet. So you could see some shifting, but even publicly and openly in the last few days, we've heard Carney say that this is close. We've heard the Natural Resources Minister yesterday in committee say this is close. Obviously, Danielle Smith on her radio show said the same thing. I can tell you you sources describing this MOU as something not necessarily that's going to get a pipeline, but that will push the pipeline project forward. Crucially, when it comes to Carney's other environmental plans or things that he hinted at in the budget, those also likely to be in this MOU as well. So you're likely going to see the necessity for some sort of tanker ban carve-out. There's probably going to be some scrapping of the emissions cap, changes to the industrial carbon tax system, some clarity on the Pathways carbon capture and storage project. I would look for all of those details to be included in some measure or outlined a little more specifically in this MOU when it comes to this pipeline proposal. Interestingly, and one thing that is worth pointing out, when it comes to the tanker ban in particular, obviously this has been a real issue in BC. We heard the Natural Resources Minister yesterday in committee say that the federal government would work to clear any barriers that exist for a proponent of any project, so long as they have the buy-in and support of First Nations and the jurisdiction. That will be the challenge. Obviously, they have shown that they are willing through the MPO and through Bill C-5 to skirt some of the environmental regulations that Justin Trudeau brought into effect. But the buy-in of local First Nations and BC in this case has been not necessarily there at this point in time.
And this is the tanker ban that would that prevents ships above a certain size docking in the north
of Victoria, or north of the Vancouver Island all the way up to Alaska, essentially, is where it limits the flow of large tankers that you would need to ship oil into Asia from a northern BC coast refinery.
Right. And David Eby, though, the Premier of BC, says, I want to be at the table in these talks.
Yes, he does. This is now, to be fair to Eby, there has been some confusion about the level of involvement in which Scott Moe, the Saskatchewan Premier, has been in these talks. He said he was involved last week. We spoke to him last night on Power Play. He said he was more of an advocate for this project, that he wouldn't be a signatory, for example, on an MOU should there be one. Still, though, Eby has been quite aghast at the fact that he feels as though he hasn't been properly consulted on this project. We've also seen him change his tune a little bit from something of this project is never going to happen to yesterday, saying that there should be no taxpayer dollars for this project. But if there is going to be taxpayer dollars, there should be a cap. And if there is no cap, then BC should be getting an equivalent amount of taxpayer dollars back. He put that at the $50 billion mark. And so we are seeing a bit of a recognition from the BC Premier that this is an MOU that is likely coming.
Thanks very much, Colton. Colton Prell, our colleague at CTV News. Okay, coming up, we're going to check out some early market movers on Bay Street and Wall Street. Remember, Jeffrey says none of the big Canadian banks are a buy right now after their run-up. We'll be right back. Tensions between Canada and the US are causing many snowbirds to opt out of heading stateside this winter, and it may even affect travel for American Thanksgiving. CTV's John Venevalo-Rao filed this report.
At Toronto's Pearson Airport, this is typically a busy week for U.S. travel, with American Thanksgiving on Thursday. But this year, the lines may not be as long as usual.
I try my best not to go to the States right now. The whole country's in a conflict.
I am not going to the U.S. at all.
Many travelers continuing to boycott travel stateside since relations with our neighbors remain strained. Something brought up by several American senators from border states over the weekend as they attended an international security conference in Halifax. Some calling Trump's tariffs a mistake, noting not only the economic damage, but how Canadians are responding personally.
But the deeper problem is the cultural break. The idea that Canadians now don't think of Americans as their friends and their neighbors, but as an adversary.
We're your friends, and we're going to do everything we can to put things back to the wonderful relationship that we've always had with Canada.
The troubled state of that relationship reflected in the latest travel data, showing in October return trips by car from the U.S. were down 30% compared to a year ago, and by air they fell 24%. We caught up with Brian Ireland as he headed off on a holiday to Cuba. He says this year he didn't even consider going to Florida.
Not at all. Not at all. We just try to stay clear there right now. We're not involved in the politics, and we're happy to be a Canadian.
A recent poll found 70% said they'd feel uncomfortable traveling to the U.S. this winter. 65% said they were concerned about new border requirements for long-term visitors, including fingerprinting.
Still, some of those U.S. senators remain optimistic the damage to relations can eventually be repaired, with one of them, an independent, simply calling the tariffs ridiculous. John Benavalli-Rouse, CTV News, Toronto.
Let's check in on the equity market. We'll take a look at the TSX here. Up in early trading, very marginally, only a fraction, a sliver of 1%. Some stocks of interest here. TD Bank hitting its highest in at least a year. And there you have it. I'm going to check whether it's near record highs, but certainly hitting today, hitting its highest in at least a year, according to my Bloomberg screen, although down marginally in early trading. Remember, Jefferies cutting Royal Bank and TD to a hold, warning that none of the Canadian banks are a buy right now after the major run-up in the shares. Royal Bank, speaking of which, also getting downgraded. That stock higher, and it's trading in record territory right now. National Bank of Canada, similar story, trading in record territory right now. I'm just looking at TD Bank here. TD Bank's closing price yesterday was a record high, according to my screen. So TD Bank, yep, down slightly today, but hitting a record high close yesterday. Let's have a look at Dollarama, because that's trading in record territory as well. Great-West Life, Canadian life insurance, doesn't get much more exciting than that. That stock hitting a record high. And Well Health down. The Globe and Mail says the Competition Bureau sniffing around that company's power in medical software. We'll be right back. Welcome to the second hour of The Open. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Shares in Alimentation Couche-Tard up about 4%. The Canadian convenience store and gas station Empire posting profit that beat estimates in its latest quarter. Revenue in Canada and the US, certainly in the merchandise segment, beat expectations. The Circle K owner says the quarter was boosted by acquisitions. However, fuel prices and wholesale fuel revenue were lower. Shares in H&R REIT up about 3%. Canadian real estate player is selling retail and office properties in Canada and the United States for $1.5 billion. H&R says the step is part of its portfolio strategy. Earlier this month, the company ended a strategic review process without a sale. It also posted operating income that missed estimates. There are multiple reports that the federal government in Alberta have agreed to the broad terms of a deal to support a new oil pipeline to the west coast. Provincial and federal leaders are reportedly set to announce special exemptions and political support on Thursday. BC Premier David Eby has expressed reservations over the plan. He said he spoke with the Prime Minister, Mr. Carney, who told him the details were not finalized. Let's look at the TSX edging higher today. Let's see how the U.S. markets are doing. Yeah, slightly down, but that's after a strong rally over the previous couple of sessions in the tech stocks. Let's have a look at oil. There is talk of possible peace in Ukraine if the Ukrainian government can be induced to accept terms that many have criticized as a handout to, or really just handing victory to, Russia's Putin. Let's have a look at gold, see how it's faring, and gold holding its own today. And finally, the Canadian dollar. Let's see how that's doing. And it has been in something of a range over the past couple of sessions, but weaker lately, down, trading below 71 cents US today. Our guest says we're likely to see more choppiness in the markets. Remember, there was some pretty significant selling last week, especially among the U.S. tech stocks. We're joined by Mike Vinokur, portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. Great to see you, Mike.
Thanks for having me here.
So even though November and December are great, traditionally good months seasonally for the market, you see a risk of more selling?
Yeah, I mean, the markets were very, very strong without any kind of meaningful correction this year, and that's just not typically normal course. We did have the start of maybe something, as you said, last week. We think we need a little bit more follow through. The market in the U.S. has been very narrow with the tech stocks, very few of them, you can count them on two hands, leading the charge. And we're concerned that unless the market really broadens out to more names within the S&P 500, as some people have said, the other 493, and into the more small mid-cap stocks, that you're going to see some more downdraft and selling because of what you're seeing with NVIDIA, Microsoft, and some of the other tech titans that most recently have had pressure.
And you reckon there is a rotation away from the Mag 7 with the exception of Alphabet?
For the time being, yes. We think that Alphabet, we were a little surprised to see how extended Alphabet is. There's certainly some euphoria. First, you had the Oracle of Omaha giving it the check mark, if you will. And then the other day, Mark Benioff, was wowed by Gemini. And now you're hearing about chips. I mean, Alphabet's a wonderful company, but we're value managers and we're looking at these valuations and we're a little bit puzzled. We think it's a little bit too much too fast.
I wonder, at this rate, maybe it already has, but Google looks set to break the $4 trillion US mark.
I think if I saw this morning pre-market, it hit that. I don't know if it traded there during market hours, but I think pre-market it may have come very close. Yes.
Yeah, it's really amazing. And even a few months ago, people thought, oh, well, AI is going to hollow them out. They're certainly close to 4 trillion right now. But people, it looks like they're now seen as an AI winner with the latest version of Gemini.
That's right. And, I think the mistake was people thought that the golden egg of Alphabet, which was search, was under attack. And at the margin, we agree. But, this past March, we entered the position because we thought, wow, everybody hates it as a value manager. That's when you want to buy, when there's blood in the street. It was trading at, 15, 16 times forward earnings. We thought, wow, what a bargain. Now at these levels, I would be concerned that, there's a little bit too much good news baked into this thing.
Okay. Did you guys buy into Google, though?
So we did. We purchased Google in March. And
I see.
Unfortunately, for now, we sold out a few weeks ago. Wow. So we missed the last, 5-7%. We'll see. But we thought it was fairly valued in the close to sub 300 range. And now I'm seeing it above 300. So, of course, I wish I had kept it. But, we had a 60% rise in 6 or 7 months. So that's pretty good.
And it's an axiom of investing, isn't it? Every time you buy a stock, it goes down in the near term. And every time you sell a stock, it goes up.
For sure.
Yeah.
But, Bernard Baruch used to say, forget about the first 20 and the last 20. Give me the 60 in the middle, right? So we try and stick to that mantra as much as we can.
Looking at NVIDIA here, it's now down 17% from its record at the end of October.
Yeah. Well, that's what happens when everybody gets onto the same side of a trade and gets onto the same bandwagon. I wish we had bought it. Full disclosure, we never did. But I think that at this point in time, there's going to be a much steeper correction on this security.
Oh, you think there's more pain ahead for
I
NVIDIA?
think there's more pain ahead because you're seeing the broadening. AMD is starting to be a competitor. Now Google, Alphabet may be a competitor. Intel is getting funding from the U.S. government. I don't know if they can be a direct competitor, but I guess the concern is, will they be able to retain the stronghold on all of these data center chips? We believe not. And if that's the case, then what happens to margins? What happens to sales growth? And is a 30-odd PE warranted?
you reckon there's signs of excess euphoria in the market in terms of credit spreads, people willing to take on risk in the bond market?
Yeah. So if you look at the MOVE index most recently has been very subdued.
What's that?
So the MOVE index is a Bank of America index which tracks the volatility mostly in treasuries, right? So the treasury market has been very subdued, but corporate spreads trade typically off of treasury spreads. And so if the treasury spread volatility is very subdued, then generally the corporate market is sort of in the same vein. Now, we are looking at the high yield, or what's typically called the junk market, and we're seeing a little bit of pressure, which makes sense because of the high-profile bankruptcies of Tricolor and a few others. Jamie Dimon making the comment of "there's never one cockroach," right?
Yes.
So, the interplay there. But you would have thought that at this point the spreads should widen a little bit, and so we're concerned that there's a lot of complacency in that market right now.
Tricolor being an entity was fueled by private debt and ran into trouble. Yeah. Salesforce, it's interesting. It has been out of favor. People concerned about AI changing that software, changing the software industry. You see value in CRM, though.
Yeah, absolutely. First of all, you gotta bet on the jockey, not just the horse. We think management is key, and management at Salesforce we think is wonderful. Mark Benioff has been a great leader. You look at the balance sheet strength of this company. They've got net cash position. If you believe analyst estimates, and we do, we think they're actually underestimating the force of Agentforce and their ability to create AI agents to help their customers' businesses reduce operating costs. And I think that Salesforce itself may benefit from even more cost reductions within their own organization, which means their margins should expand even more.
We better jump. Thanks, Mike.
Thank you for having me.
Mike Vinokur has been our guest. Coming up, we're going to get more on Alphabet nearing the $4 trillion US market capitalization, and also pushing deeper into the chip business, possibly teaming up with Meta. We'll have more after this. Alphabet, popular with investors this week, to put it mildly, stock hitting record highs. And now it seems that Meta is going to spend billions on Google's AI chips. This sounds like a threat to NVIDIA. Let's get more from Mandeep Singh, Global Head of Tech Research at Bloomberg Intelligence. Mandeep, thanks for joining us. Just fill us in. I mean, so Google are now a producer of chips in a big way?
Well, Google has this all-stack solution when you think about, generative AI and how it's getting deployed. They make their own chips, the TPUs, then they train their own large language model, Gemini, and then they have got their own surface area with the family of apps, including search and YouTube, where they deploy that AI. So really, it's a vertically integrated stack solution, and everyone sees the proof in terms of how efficient they have been in terms of their CapEx versus the rest of the peers, especially Meta, because Meta spent almost $70 billion in CapEx this year. They don't have a cloud business, even though they saw some bump in their recommendation systems. But Alphabet has done far better in terms of making use of their own chips and deploying them in their search business. And so that's where I probably think everyone is realizing Google has a moat in terms of, making these chips and then running them efficiently.
And I mean, obviously, Meta would be delighted to find another supplier of devices so they can have more bargaining power against NVIDIA.
Yeah, and look, it's very surprising to me that Meta is looking to buy something from Google, given, they compete in the digital ad space for the same dollars. So what this shows is, everything is changing in terms of ecosystems, the stacks that I talked about. And for Meta, the bigger fear is, if they plan to deploy $600 billion in CapEx over the next 3 years, they're too dependent on NVIDIA. In fact, NVIDIA has mentioned for every gigawatt, they would be getting, a content increase of up to probably $30, $35 in total, in terms of cost of building that AI data center. So from that perspective, Meta doesn't want all their chips to be NVIDIA. They want to diversify. And right now, Google is the most viable option. I'm sure they will be looking at AMD as well. But clearly, Google has shown that they are doing it at scale and doing it very efficiently.
And just give us an update on this Gemini 3, the latest update of their AI program. A lot of hype about apparently the boss of Salesforce says it blew him away. How significant is this for Alphabet?
I mean, the reason why their TPUs didn't get as much press before is because their model was trailing behind OpenAI and Anthropic. Now everyone sees Gemini 3 is almost comparable in capabilities as the leading OpenAI and Anthropic model. In fact, Anthropic has also trained some of its models on Google TPUs. So two of the frontier models have been trained on Google's chips, and they are leading models, in terms of capabilities. And that's why everyone is excited about Gemini 3.
That's amazing how Alphabet, after people thought, oh, they're going to have a big problem with AI. And I got to admit, I often, when I search, I just read the AI summary. But anyway, they've turned things around.
Yeah, and their search business actually accelerated in the latest 2 quarters. So clearly, they're not seeing any impact in their traditional search revenue.
Just one last question. We're very tight for time, but when I do a search now, will I start seeing ads pop up in the actual AI search results?
I mean, you're already seeing that with the way Google has integrated AI overviews and AI mode. They still show you ads and they're seamless. It's just they're going to be more targeted. And I think that's what Meta is looking to do as well with all this big build out of AI infrastructure. They are looking to make the ads more targeted, and that's what's going to drive ad pricing on their platform.
Mandeep, thank you very much indeed. Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. Up next, we're going to put the spotlight on Japan for today's ETF report, and we'll tell you why Japan, whose government is proposing economic stimulus, is raising concerns about the global financial market and the possible demise of the famous carry trade. We'll be right back. Japan's new prime minister is proposing a radical economic stimulus. Now, that has been hard on Japanese bonds because, of course, it'll tend to increase the government's debt load. But so far, Japanese stocks have been holding up. And that's our spotlight for the ETF report today. One way in Toronto to play the Japanese market is the BMO Japan Index ETF. There's the stock over the past year, ZJPN, and you can see it's had quite a rally after that bottoming. All markets pretty well bottomed in April amid fears over U.S. President Donald Trump's tariff threats. Let's have a look at the big holdings in this particular fund, and you can see it's familiar names: Toyota, Mitsubishi Financial, giant banking entity, Sony, Hitachi and SoftBank. So you got quite the spread there between high tech and a more traditional industrial company. It uses this ETF does use financial instruments to try to hedge Japanese currency exposure. Well, let's stick with that theme of Japan announcing a new $1 trillion stimulus package. It could have wider implications for the global economy. Our guest says that rising bond yields in Japan will tighten global liquidity, increase overseas borrowing costs, and could pose challenges for equities, debt, and cryptocurrencies. We're joined by Thomas Urano, Co-Chief Investment Officer and Managing Partner at Sage Advisory. Thanks very much indeed for joining us.
Yeah, thank you. I appreciate the time.
So we've had Japanese interest rates going up, long bond yields hitting their highest in decades. And so just give us the background. We've had for it seems like a generation we've had this so-called carry trade. Investors would borrow cheap in Japan and invest elsewhere. So that may be eroding now. Can you tell us why that matters?
Yeah, so we've had for decades a scenario where funding costs, i.e. interest rates in Japan, have been demonstrably lower than the rest of the world, right? Which made it attractive for international investors to borrow yen or fund in yen and turn around and move those dollars or those yen into other markets around the globe, either in higher yielding or higher returning assets, whether that be fixed income or risk assets. So it's been a scenario where Japan has been able to export capital to the rest of the world, and that capital, of course, found its home in various asset markets. However, as we've seen over the last several years, the yield in Japan, interest rates in Japan have been rising substantially. 10-year JGBs have risen 7x since the fourth quarter of 22. They've gone from 25 basis points to now 1.8%. And the problem with that is, as you include your FX hedge costs into that, suddenly the interest rate differentials make it less attractive or unprofitable even to move assets out of yen or fund in yen and invest overseas.
So this could dry up liquidity or a source of funding that investors and speculators have used for decades?
Sure. So as those funds have moved out of Japan into the rest of the world, if the dynamics of those economics shift, meaning rising JGB yields increase the borrowing costs or make it more attractive for institutional investors in Japan to bring that money home, i.e. repatriate those dollars back into yen, that's going to be some headwinds, right? That's going to be a draw on capital from foreign markets back into Japan's market.
So there's a double whammy here. Then money could be drawn back to Japan to buy domestic money to buy their local bonds, but also there could be a source of funding cut off for the global market.
Sure, right, and that's exactly the risk here that's occurring, right? If this happens in size, and those differentials in funding versus yields abroad, if they become significant enough to motivate investors to move money back towards yen, what does that look like? That could be headwinds for yields abroad, right? As some of those investors have been borrowing in yen and investing in sovereign domestic markets, U.S. yields, European yields, emerging market debt. If that money leaves, it could be a headwind for yields in those markets. It would add FX volatility as you start to think about unwinding hedges and move from foreign markets back to yen. And then I think that would just, in general, be a headwind as a liquidity drain on markets globally.
That's interesting, isn't it? I wonder, could that be, I mean, who knows? It was the failure of an obscure Austrian bank that helped to spark the global depression in the 30s. I wonder, could this be a catalyst?
Sure. I'm not saying that we're going to have a depression, right? No. But I would say one of the tailwinds that's been occurring for decades because of the interest rate differentials in Japan versus the rest of the world has been Japan has been a large exporter of liquidity, right? And maybe that tailwind is drying up. There's been a significant, I'll say, rewriting of yield differentials between Japan and the rest of the world. And if that's the case, then fund flows back towards Japan, or at least a lack of additional flows from Japan into foreign markets, again, could be a headwind for liquidity going forward.
And Japan, it seems like forever, since at least 1989, when I think the previous peak for their market was, it's just had this moribund growth. This new leader in Japan determined to juice that?
Sure. I think if you look at Japanese equities, what are they responding to? Well, on the one hand, $135 billion stimulus package designed to support GDP growth, which has been lagging in Japan, right? So what are they talking about doing? This is the largest package since the pandemic. They're talking about providing energy subsidies, tax cuts, some handouts, basically anything they can to support direct consumption in Japan and GDP growth in Japan. So a positive aspect, to be sure, but also consider the concept too that if there's this repatriation effort, what does that look like? That means some dollars moving back to Japan that can also be supportive for capital markets in Japan.
It is fascinating that I do remember, I think this was prior to the housing crisis, though. People in markets like Hungary were borrowing money at low Japanese interest rates and buying real estate. So this has been going on for a long time, this cheap Japanese funding.
Sure. Yeah. Like I said, Japan has been a funding currency for decades. The fact that differential is changing, I think it's just something investors need to pay attention to, right? If it's a scenario where, funding in local markets in Japan is going to dry up liquidity and depress investment demand for opportunities in foreign markets, it's certainly a headwind for capital appreciation in those assets.
And what about Japan itself? Can you generalize? Is the equity market there looking like good value?
I can only say that I think in terms of Japan on the equity side, you have to respond to what the growth picture looks like there. Right? They've been struggling, right? There's a reason the new prime minister is coming on board. There's a reason she's proposing a very substantial stimulus package. Their GDP growth has been weak. It's been sub 1%. For third quarter of this year, it was actually in contraction, down about 40 basis points. So, thinking about equity growth or equities in Japan, I think you have to think about what's the outlook for obviously domestic growth in Japan, but then also, there's some hope involved here that the stimulus package will help drive growth back into positive territory. Targets or estimates are somewhere near 1.25%, maybe 1.5% for 2025. And perhaps the stimulus package could push it a little higher than that.
Thank you very much indeed. I really appreciate it, Thomas.
Thank you.
Thomas Arano, Co-Chief Investment Officer and Managing Partner at Sage Advisory. Coming up, U.S. retailer Kohl's raising its full-year forecast for a second straight quarter. We'll have more when we come back. There are multiple reports the federal government and Alberta have agreed to broad terms of a deal to support a new pipeline, an oil pipeline to Canada's west coast. According to the reports, provincial and federal leaders are set to announce special exemptions and political support on Thursday. BC Premier David Eby has been opposing the plan. Eby said he spoke with the Prime Minister, Mr. Carney, who told him details weren't finalized. Shares in Alphabet and Nvidia moving in opposite directions today. A report from The Information says Meta Platforms is in talks to use Google's AI chips in its data centers by 2027 and may also rent chips from Google's cloud division next year. Investors believe a deal would signal growing momentum for Google's devices and create a long-term potential to challenge Nvidia's market dominance. Shares in Zoom Communications climbing. The video communication company posted revenue that topped expectations, with sales jumping more than 4%. Zoom has been pushing a broader range of products and says it's seeing strong momentum with its AI Assistant and AI Customer Experience Suite. There's a look at North American markets. The S&P 500 now narrowly a positive, helped, of course, by that jump in Alphabet, hitting new record highs today. Let's check out the movers south of the border. We're joined by Bloomberg breaking news editor Laura Stanley. Laura, thanks very much for coming on. Retail is on your radar today. Kohl's, start with that one if you would, please.
Outlook boost for Kohl's here. This is the second consecutive quarter they're boosting their outlook, and this is really signaling that maybe the company's turnaround is working. They have a new CEO just this week. They announced that their interim CEO, Michael Bender, was named the permanent CEO. So even though they've had a little bit of a tough past, they've had 15 straight quarters of declining revenue. Now we're seeing maybe what could be a little bit more of stability for the company, that they're moving past this recent turbulence. And this is them joining a growing list of retailers, showing consumers are willing to shell out for new items, especially when they tend to be priced at a bit of a discount. We had other companies that raised their forecasts like Best Buy, Dick's Sporting Goods, which we're about to talk about in a bit. And so this is really painting a picture of shoppers that are still opening up their wallets despite this uncertain consumer environment.
And yeah, Dick's Sporting Goods, what's going on there? You would think it's discretionary, that kind of stuff. You don't really need a new tent, although you may want one.
Dick's is an interesting one to look at because what the stock is really reacting to this morning is investor concerns around their big acquisition. They have a $2.5 billion acquisition of Foot Locker, and there are a lot of acquisition costs that they're incurring for this. They could see pre-tax charges of up to $750 million, and there's a lot of logistics and admin that have to be sorted out here. And especially investor concerns that these two companies just have very different business models. Foot Locker is very mall-based versus Dick's is more into big box suburb type of locations. So the question of combining them is really bringing up these extra costs. And the executive chair came out with some powerful language here, saying that the company is, quote, cleaning out the garbage at Foot Locker. So clearing out that slow-moving inventory and closing weaker stores. So we have that, which is what's sending the stock down. But they did raise their outlook as well, as we were just talking about when it comes to these retailers doing relatively well, adding to a strong run for Walmart, Ross, TJX. So this is really about these customers hunting for deals here. And that's something we're seeing with Dick's as well.
Lara, thank you very much indeed. Really appreciate it. Bloomberg's Lara Sanley. Coming up, hot picks. We're going to check out 3 plays in trucking and logistics. We'll be right back. On Hot Picks today, we're focusing on transport and logistics companies. Our guest says FedEx is his top idea. He reckons it's positioned to benefit from growth in e-commerce. We're joined by Jason Seidel, analyst in transportation and logistics at TD Cowen. Jason, great to see you. Give us your case on FedEx. What attracts you to this stock?
Sure, Andy. Well, listen, it's great to be here, and happy Thanksgiving to all the U.S. Listeners out there.
Sure.
So look, FedEx right now, when you look at the where it's trading at roughly in line with its historic average. But remember, the company is going to be breaking out its LTL division for investors. So we're really looking at this thing as a sum of the parts, because your LTL business tends to trade at a much higher multiple than does your parcel portion. Near term, don't expect a lot out of FedEx or even UPS when you're looking at the parcel guys. Peak season expectations, I'd say, are somewhat muted. Your business from your larger customers is probably in line with historical trends in terms of your peak season expectations, where your SMBs are a little bit more muted. In other words, people that probably can't shift as much with the changes in the tariffs and everything else. But the good news is that both FedEx and UPS are remaining very, very disciplined on pricing. Now, you can't overlook a recent tragedy with that UPS had with one of its freighters. The MD-11s are grounded for both carriers right now. It's a workhorse for a lot of them, but it's not a large percentage of either of their fleets. FedEx, it's actually a little bit smaller. It's about 4% versus 9% at UPS. We're expecting these guys to really just sort of shift a little bit more to the ground, maybe deploy some extra spare aircraft and adjust some of the maintenance schedules going forward, and even probably take advantage of some of the belly space of some of the consumer airlines that are out there. Longer term, when you look at FedEx, one of the things I think that excites investors is really looking at the changes that they have in their network that is coming, because most people don't remember that FedEx was actually created by just an air network, and then they added the ground later. So they're really going to be right-sizing their network going forward. Instead of having 2 FedEx truck stop at your house, they're going to try to go to 1 in as many places as possible.
Right, so that was that deadly plane crash in Kentucky, forcing UPS and FedEx to ground their fleet. Yeah, 14 people killed in that one. GXO Logistics, remind us what they're all about and what attracts you there, Jason, please.
Sure. So, when you look at GXO, they're basically an automated warehouse provider and really a supply chain coordinator. When you look at automation in the transportation space, a lot's focused on automated trucks and sort of that's on the come, but it's been on the come for many years right now. There's also automated talk on the rail side, but there's a lot of pushback there as well. There's really no pushback on the warehousing front, and this is where they play. There's a new CEO that came in recently, Patrick Kelleher. He's come over from DHL, very well respected in the supply chain. He's refocusing the company on sort of organic growth and expanding into some areas that tend to be a little bit higher margin. But the really interesting thing about these guys is they tend to lock up long-term contracts, and the renewal rate on these contracts are in the 90+% range. When you look at what they've locked up for 2026 through the third quarter, it's almost where we're expecting them to grow all in. So they've got a lot of their growth already locked in. We suspect when they report 4Q, they'll have almost $1 billion in revenue booked for 2026 in new contracts. So there's an exciting story there, and also a recent acquisition that they did, Wincanton, that was held up by the British regulators, is set to pay some dividends right now. So it was held up, so they really couldn't take advantage of some of the cost savings. We expect that to flow through about $60 million for their EBITDA. And then on top of that, we expect that to allow them to expand more into the A&D consumer base, which should position the company in the years to come.
And then finally, Knight Swift Transportation, KNX in New York. What's distinctive about them, Jason?
Yeah, well, I'll start off by saying in the U.S. trucking space, things are bad. So that's there's no way to get around this right now. But really, and we've been in the downturn, by the way, for over 3 years, the longest I've seen in my 30+ year career in logistics. That's the bad news. The good news is we're starting to see ways capacity can come out of the marketplace. And a lot of that has been driven by the government. So the FMCSA, which is under the DOT, has issued several rulings. The biggest one out there is the non-domiciled driver ruling. And we estimate that can impact roughly 8% of the capacity over a 2-year period of time. Now, that's stayed in the courts right now. We expect that stayed probably be lifted or maybe sent back to the FMCSA. But that's a lot of capacity to take out of the marketplace, which should, all other things being equal, help pricing. You add on top of that some English language proficiency testing that should take some drivers out of the marketplace, as well as illegally issued CDLs, commercial driver's licenses. Those things will be taking capacity out. Recently, California was hit with 17,000 taken out of the marketplace. That's almost 9% of their CDL capacity. Now, mind you, maybe not all of those were active, but still, this is a way to take that capacity out of the marketplace and provide some much needed help to the U.S. trucking industry, which has been really sort of under the thumb of lower pricing for the better part of, like I said, 3 years.
And just what went on with those driving licenses? There was fraud in the system?
Well, unfortunately, there's been a lot of fraud in the system. I mean, you have what they call CDL mills, which will get you your CDL in 1 day. Think about that. You can get a driver's license to drive an 80,000-pound vehicle in 1 day. There's a lot of issues right now that they're looking to correct, and a lot of it is around safety. So I know there's, a lot of it's been politicized, unfortunately, but when you look at the things that they're doing, the focus is on safety, and that makes a lot of sense.
And is this kind of fraud happening in Canada as well? Can you give us any color on that?
Yeah, Canada's had some issues too with some of the some illegal drivers coming up, sort of setting up shop and then closing down really quickly and moving around. They have their issues as well. So it's not just the U.S. I don't want to paint such a bleak picture for my home country, but it is an absolute problem. And on top of that, you have violations of the cabotage rule, right? Like, so when you're looking at drivers that are supposed to, come in, let's say from Mexico and drop off a load and then go back, they're not allowed to solicit other business once they're in the U.S. And I believe typically they have about 7 days to do so. You're finding a lot of these drivers are staying up to 20+ days in the country and are probably soliciting other work. So there's a lot of stuff that they're looking at right now to curtail that capacity that's expanded so much sort of post the COVID supply chain situation.
Jason, thank you very much. You gave us great insight there. Really appreciate it. Jason Seidel has been our guest analyst in transportation and logistics at TD Cowen. Let's check out some notable analyst calls and recommendations. CIBC Capital Markets has raised its price target on Altus Group, the provider of real estate data, to $62 from $54, but is sticking with a neutral rating. Altus just hosted an investor day in New York, providing updates on capital allocation, portfolio streamlining, and operational targets over the medium term. CIBC says it was encouraged by a plan to divest non-core operations and get capital back to shareholders. CIBC says a refreshed strategy at Altus under new leadership sets the stage for a renewed and more focused company. However, the future path closely tied to actually achieving on key priorities. Our second notable call is on the chemical giant DuPont de Nemours. Deutsche Bank says DuPont can become a compounder and the stock should be bought. It says that this company could, quote, enter the rarefied air of growth compounders, referring to companies that increase sales and earnings at above market rates. The analyst at Deutsche Bank sticking with a buy rating. That's after the spin-off of the company's electronics business, and Deutsche sees, quote, better days ahead. The price target, $46 US a share, up 20%. And finally, our third notable call is on SoFi. Truist is lowering its price target on SoFi Technologies to $28 from $31. That's in US funds, and sticking with a hold rating on the stock. The company is lowering its estimates for revenue and earnings in Q4 next year and 2027, partly due to tougher comps, because the company is beginning to lap some outsized growth on its loan platform business, the analyst warning investors. Coming up, why gift cards are hot this holiday season as Canada remains stuck in a trade conflict with the U.S. As holiday shopping ramps up, downtown districts across Canada are trying to keep the spending close to home. Some are offering discounts on local gift cards as an incentive to pull people into small stores. CTV has more on this report.
On Charlottetown's main streets, the search for the right gifts for loved ones has started.
Family, friends, neighbors.
And as costs climb, shoppers say they're being more intentional about where their dollars go.
Definitely supporting your local artists and your local community. It's so important for our economy.
Making sure that we support our friends, family, community, our country, our pride.
This week, Islanders and businesses got an extra boost. Local gift cards offered by Downtown Charlottetown Incorporated were 20% off, a one-day deal to promote spending at shops in the community.
If it benefits a business, it benefits the community. It means that there's more attendance at events. It means that there's more tax base for social programs.
140 plus stores and restaurants are participating, and Charlottetown is one of more than 40 cities across Canada that have joined the Downtown Gift Card program. The aim is to drive some sales away from massive online retailers into small independent businesses. Owners say every customer coming through the door counts.
With the trade negotiations with tariffs, we've seen a real surge of people finding it important to support local, shop local.
For stores on this street and beyond, a holiday shopper today could be a return customer tomorrow, and that can make a real difference. Maria Sru, CTV News, Charlottetown.
And just a reminder, yesterday on Market Call, Paul Harris was our guest. His ideas were First Service, Zoetis, the animal health giant, and Adobe. And today it's real estate with Andrew Moffs of Vision Capital. He's focusing on real estate stocks and REITs. Right, before we go, let's update you on the action in the markets. We did see a soft open for U.S. stocks, but the S&P 500 now positive, boosted, as I mentioned earlier, by Alphabet, trading once again in record territory, this time apparently on optimism over the company's chips. They're apparently becoming a growing force in actual devices for AI computing. Alphabet up 2%, NVIDIA down about 6%, Tesla slipping about 2%, Advanced Micro down 8%, perhaps people worried about competition from Google. Their Meta platforms higher by about 2%, and Oracle down 2%. Interesting that the massive debt load they're incurring for the AI build-out, worrying investors. In Lennar, I see Lennar, the big home builder in the States, up around 4%. So there is a look at the broad markets. Let's check out the TSX over the past week and past year first. And you can see the TSX up nicely, up around 21%, even excluding dividends. It's been a winner this year. Let's have a quick look at the past week, though, the past 5 trading sessions, and you can see our market is ahead about 3% in the past week. So despite the sell-off on Thursday, I think Thursday was the bad day, but we did get a rebound. Let's have a look at energy stocks today, in particular, or energy commodities. Let's have a look at oil, because there is talk, of course, of the chance of an end to the killing in Ukraine, and that, of course, could buoy supply from the United States. But the Ukrainians, they may be under pressure to accept a peace deal, but they have been attacking Russian Black Sea oil installations once again. And there is oil down 20% in the past 12 months. Let's have a look now at the metals, because we have seen strength in gold today. Gold is still shy of its record highs of October, but moving higher in trading today, up about $25. And Barrick Gold, maybe we can put up ABX. According to Bloomberg, the company has agreed to pay a settlement valued at $430 million US as part of a deal to end that dispute with Mali in West Africa. They have to sign it within 6 days, according to sources who talked to Bloomberg. But the Canadian company will retain operational control over that giant complex. Mali is to drop charges against Barrick and take legal steps to release 4 employees who were jailed during the dispute. Let's have a look at Bitcoin, because it has been suffering through November. People cautious about the valuation on tech stocks, also dumping Bitcoin. And so you can see Bitcoin now down about 2%, despite massive support from the U.S. administration and, of course, participation in the crypto industry by members of U.S. Donald Trump's family. Thank you very much indeed for watching the Open Morning Markets. Up next.